let's turn over to Coinbase land. This was a very, very powerful tweet that went out last night from Brian Armstrong, the CEO and founder of Coinbase, saying that there are rumors floating around that the SEC may stamp down on top of retail staking. Staking, of course, is used for proof of stake networks such as Ethereum, allows you to take coins, put them onto an address, and secure the network, and then earn a little bit of the native token in return for your security you're bringing to the network. This is in turn compared to mining, which is used for Bitcoin, where you're pointing a computer at the Bitcoin network and providing security by just basically using energy. Staking, a lot of people think it's a lot like a security, and some people in the SEC might think that as well. Coinbase tweeted about this, or Brian Armstrong tweeted about this, and it's a pretty big measure of Coinbase's revenue. So this is like something that's actually very important to their core business. I hope this doesn't happen, but this was Kyle last night. It was like fire alarms going off for a lot of people. Were like, is this actually happening? Because Brian Armstrong wouldn't just like tweet that out of the blue. Zach, up to you.
Yeah, you love it when Brian Armstrong goes off the cuff and just tweets out, the things that they're hearing in the industry. You really do love to see it. It does get the conversation going pretty quickly. Yeah, Will, you're right. I mean, if you look at the last earnings, it was something like 11% of all revenues were related to staking rewards, right? And these are things that make it easy for people to get rewards on the things that they already have in their Coinbase account, right? This is a way for people to get that yield that wrecked a lot of people with a lot of the centralized lending outfits that were out there. This is a bit technologically different. There's obviously less risk associated with it, but it is that sort of quote unquote interest that people like to view as being able to get with their crypto holdings that they wouldn't otherwise be able to do. So anyway, I think like the idea that this may run afoul of securities laws is something that has been discussed in the past. And if this does come to pass, I think that's obviously a bit disappointing for retail's ability to participate in securing some of these proof of stake networks. But hey, I don't know. It may just be a rumor. It may not come to pass. We'll see. Adam, I think I saw your hand. It's us to you.
Yeah, so I mean, let's just talk about what the SEC is nominally supposed to do. They're charged with protecting investors, and typically the way that they do that is they mandate companies that are registered with them to release certain types of information. The purpose of this is because in especially companies, you're talking about environments that have a lot of what's called information asymmetry, right? So the people who are running the company know a lot more about what's going on within the company, its future prospects, et cetera, than the people who are investing into the company. So that's what they're supposed to do. That's actually a good function. It makes it so that so long as everybody has all the information, then you can make correct decisions. At least you can make decisions with as much correctness or as much potential for correctness as anybody else. But it's important to note that the SEC doesn't require that investors read those materials that are released. They just require that they be released. So you take that argument and now you transpose it over to staking. What is staking? Staking is locking up your tokens in a way where nobody can spend them, including yourself, to be part of consensus. And you're being part of consensus on an open, public, decentralized blockchain network, which means that inherently, if you have access to the thing, so does everybody else, because it's on the blockchain. They're transparent structures by default. So the idea that you could take the staking process and say, well, you're making money off of this, so therefore it has all the same challenges as investing in a company is a little bit stupid, honestly. And it's like, but it's consistent if you think about this not from a perspective of protecting investors, which is nominally what they're supposed to do, and instead you think about it as a way to really, on the one side, to sort of protect the monopolies that exist out there, protect the existing market structure, which the SEC regulates, and then also to increase their power. Because if they don't actually need to have that investor protection part, well, then that means that this could apply to a lot more things, which means that they become more important, more powerful. It becomes more prestigious to be involved with this. And just in general, like if you're somebody who's going into the world of politics, even on the regulation side, a lot of times those are some of your objectives. So that was kind of the thing that jumped out at me about this, is just that, okay, like let's assume good faith. Good faith assumptions mean that there's no way that they would want to do this because there are no information asymmetries to address. So that's my read on it. But down to you, Jen.
Yeah, I agree with you, Adam. And I think you've said this on the show before. I don't think it's that the SEC doesn't understand what's going on here. I think it's that they are threatened at the loss of power over what is happening. What's interesting to me, though, is an outright ban to me means that they lose power, right? If these products go overseas, set up offshore, the SEC inevitably pushes it out of their jurisdiction and they're not able to oversee. I feel like they're losing a little bit of power there. And the fact that we see Brian Armstrong on Twitter telling us about what he's hearing, especially when it comes to regulation in the industry so often, tells me that the regulators are not willing to speak with the people who matter to actually make real regulation that can help move the industry forward happen. And that is such a frustrating thing, that these CEOs have to go to Twitter and say what they're hearing, and they're not able to speak to regulators, especially when the SEC says, our doors are open, come and talk to us. I saw a few hands go up, I think Adam and Will, so I'll let you guys duke it out for last thoughts.
You can have it, Will.
Yeah, last thought from me is just the new article from Nick Carter that came out last night. And we kind of talked about this actually last week on the Hash, or maybe it was earlier this week, and it was about Operation Choke Point. So the idea that the Biden administration and other government regulators are increasingly tightening down on the banking side of crypto in order to take the oxygen out of the room from all these different crypto projects. If you put your thumb on the banks that are providing liquidity to crypto projects, well, then the crypto projects die. And this seems to be possibly another arm of this, right? Like right now, it's a lot of speculation. It's a lot of like putting headlines together and saying like this works with this, and maybe there's something going on nefarious. But this one sort of does work within that framework, right? Like they missed the ball on FTX, and now they're going after Ethereum, even though it's transitioned to proof of stake. It's had great uptime. There hasn't been any issues. It all seems a little odd. Adam, to you.
I mean, whether you're talking about DAOs, whether you're talking about stablecoins, whether you're talking about tokenized, really anything, what you're talking about are structures that threaten the monopolies that are held by people in power today of the system. And, that means of the regulators on one side. So Jen, to your point, I think that there's a bigger game that's being played here. There's power at the regulator. That matters a lot. They're trying to maximize it, and they're trying to do it in a way that doesn't require them to pass any new rules. Because were they to pass new rules, then they would actually have to get comment from the industry. There's like this whole involved process that is designed to make it so that the regulators don't just make any rule that they want, but they make a rule that is actually the one that makes sense based on what the industry needs. They don't want to do that because, again, once you open that can of worms, they have to actually justify why this is the correct path. Whereas if they just say, oh, this is all the same thing as it was 100 years ago, then they have to make no new rules. All they get to do is just claim expanded sort of authority there. But think about it for a second. Again, these are tokens that don't require a listing on the New York Stock Exchange. These are tokens that trade globally. These are tokens that really have no way outside of, Prime Minister Modi over in India getting his way and getting some type of top-down regulations that apply to literally every country in the world, so you cannot escape. Like, this is terrifying to people who really only have these jobs and have these powers because they exert such incredible monopoly, control over these areas. So I think that it's more that than anything else. Sure, in the short term, they lose some power, if things go overseas. But in the long term, they stall for just that little bit longer, and they get to retain their power and relevance for just that little bit longer. And I got to tell you, I think that that's what's going on here at the core.
All right, big picture, big thoughts. I like it.